Is it? That what we are going to do in this lecture. Is it right? The sound will be there after 2-3 minutes. Okay, just now I have activated the sound. Don't worry about that. Is it? How we are going to classify the assets, classify the liabilities in terms of equity, non-current liabilities, current liabilities, and loans and bonds. Specifically, when we do the things, is that specifically what we are talking, we are taking into consideration what? We are taking into consideration long term. Okay? Long term. Basically, when we say long term, what will happen? We are talking in terms of equity, we are talking in terms of preference shares. Okay? Preference shares. Is it right? We are talking in terms of bonds. Bonds are different types. Is it right? Some bonds are convertible bonds. Is it right? You can convert the bonds into equity after the time period. Okay? And sometimes when you are talking about the assets, fine, we are not concerned, we are not that much concerned about non-current assets right now. We are concerned about what? We are concerned about any investments you are making. We will cover both the things subsequently here. Is it right? Now, upon the completion of the chapter, you need to for an understanding about what is the standards on financial instruments. Is it right? You will, as we are having our financial standards for IS 1, IS 2, IS 16, in the financial instruments also, we call it as a financial instrument. There will be standards. We are defining the financial instruments in terms of what? In terms of assets and in terms of liabilities. Fine. Indicate the categories. What are the different categories of financial instrument? I told you about what? When we are talking about the different categories of financial instruments, you are taking into consideration what? You are talking in terms of equity. Is it right? You are talking in terms of preference shares. Is it right? You are talking in terms of convertible bonds. Is it right? These are different types of financial statements and how it has to be treated in the financial instruments, treated in the financial statements. Definitely, all through the time IFRS 13. IFRS 13 is about fair value. IFRS 13 is applicable to all, irrespective of whichever it is there. Fair value component is not specific to one type of element of the financial statement. It through all the aspects as such. Definitely, the moment you are talking about the fair value, either you will have some gains or you will have from some losses. How it has to be treated and how it has to be shown. Now, difference between, is there a difference between debt and equity? Is that? That's what. Equity is infinite. Is it right? Equity is in forever. Is it right? Whereas debt is for the fixed period. Is it? Debt is for the fixed period. Now, there are some we don't have actually, practically if you ask me, nowadays we don't have preference shares. Exceptionally cases we will have preference shares. Is that exceptionally? What is the concept of preference shares? Is that what is the concept of preference shares? Preference shares is that, I don't know it will work or not. Is that preference shares are how it will work? Preference shares will be for a time limit. Is it right? What is the characteristics of preference shares? They have the preference of dividends over before paying to the equity shares. Okay, that's the basic thing. Redeemable means you are going to continue it over a period of time, or we are going to have a fixed period. Is it right? Account of use of debt instruments. Well, I told you some when we are talking about we have in some cases we can convert the bonds into equity. In some cases we cannot convert the bond into equity. Account of issue of debt instruments with no conversion rights. No conversion means for 10 years bonds. That's all. Is that? If you are going to say it is 10-year bonds, it is 10-year bonds. Is that? It is going to be 10-year bonds as such. Fine. It will not have any impact as such. Account for compound instruments. Compound instruments means you will have the two characteristics. Is it right? convertible to preference shares, convertible to equity shares. Is it right? Bonds convert to equity shares. Preference shares converted to equity shares. Compound means you have more than one characteristic for the financial instrument. And last but not the least, first we are talking about recognition, and the last time we are talking about derecognition, okay, including issues of factoring. Factoring is nothing but in terms of receivables, okay, how you have to remove the, how you have to eliminate the, is that how you have to eliminate the financial instruments from the financial statements. Is that's what we are going to work it on over a period of time. Fine. Now, next one. Yeah, these are the things. When you are talking about the financial assets, you are talking about the equity capital. Is that you are talking about the debt? Is it right? You are talking about the financial liabilities in terms of loans. Is it right? In terms of current liabilities also, and financial assets. If you put all the things into consideration, it is nothing but a brief summary of financial instruments. Fine. Now, just slowly. Now, what are the things? This is what very specifically, is it right? You are talking what is the financial instrument? It's a contract. It as simple as that. For one entity to another entity. For one, it is an asset. For another, it will be a liability. There are three reporting standards. Fine. This is a little bit specifically we have to understand. Okay. Where is that? Fine. The first one is IAS, the IAS 32, financial instrument, deals with the classification of instruments and how it is going to be presented. The first one is presentation. The second one is the disclosure. Is that IFRS 7? We are just working only on the basic structure of IFRS 7 and IFRS 9. Okay. Once we are covering here, again we are not going to carry forward this in the next stages. Is that we are talking about disclosure, how it has to be disclosed, how it has to be shown in the financial statements as such. Is it right? Now, the third one is how we are going to measure and how we will recognize in the financial statement. Is that? These are the three things. Is that? First, we are talking in terms of presentation, in terms of disclosure, and subsequently in terms of financial instruments. Okay. Now, what we say in terms of financial assets, as simple as that. You have the cash, is it right? You have something called as contractual right to receive cash. To receive cash, is it right? To receive cash or any financial activity in terms of what? Trade receivables, is it right? You have a to exchange financial assets or liabilities under conditions. This is the first time you are learning this. Is that this is the first time you are learning this? Under the conditions of potentially favorable, means you have the options. Is it right? This is derivatives. Is that advanced version of the financial instruments, where you have, when we say it is option, you have option to buy or option to sell. Is that option to buy or option to sell? Is that an equity instrument? You are making some investments. Is that we are making investment in the equity shares? When you are making the investment in equity shares, it is going to be identified as a financial asset as such. Now, if you take the things here into consideration, where we are focusing, make it a point. We are not taking into consideration non-current assets, property, plant and equipment. That is very, very important. Property, plant and equipment is not a financial instrument. Is it right? Financial instrument is nothing but through which we can exchange the value of the asset as such. Is that three are there? One is trade receivables, one is you are talking about the cash. Four, sorry. One is cash, one is trade receivables, one is investments, and I will put options as a last because we have the option to sell or option to buy. See, I will tell you a simple example. Is it right? You are buying a car. Is it right? You wish to buy a car. Now when you wish to buy a car, today is what? Assume today is 13th of October. Is it right? You give some advance. Is it right? You will give some advance. The value of the car, assume that the value of car is 20,000 riyals. You will give an advance. How much? You give an advance of 500 riyals. The car will be delivered around, assume it will be delivered around 2023 January. Is that now you will see if the car value, the moment you are giving 500 riyals, you will say that I will book my car at this price. Okay. There is a condition. In some cases, what will happen? The car prices, there will be a condition that whatever the current price available on 2023 on the date of delivery, you have to buy it. In that case, what will happen? Assume the value of the car is going to be, if it is going to be changed, 20,000 or less than 20,000, what you will do? You will buy. Is it right? Or what is the option? Option says that assume the value of the car is how much? 21,000 or more than 21,000. Okay. Now you will say that if I buy the car, I have to pay 1,000 more. Got my point? I have to pay 1,000 more. I will not buy the car. Whatever that, whenever you pay advance sometimes a refundable, advance sometimes non-refundable. Is that right? Assume the advance is refundable, fine, well and good. In some cases, advance is not going to be refundable. If it is not going to be refundable, what you will say? If I buy, I will pay 1,000. Is it right? If I don't buy, I will lose only 500 riyals. Is that? You will lose only how much? 500. Then you will think whether to have that, you can exercise that option or not. That is the reason we say that it is an option to buy or option to sell. Just keep this in mind wherever it is possible. I will let you know. In this lecture, we are not going to do on this in detail. As this here only we are covering it, and here only we will stop it. Okay. Next. Is it? Now, what is the financial liabilities? Is that financial liabilities is nothing but we have the thing. Is that trade payables are there, loans are there, redeemable preference shares are there. Is that the is a liability of a contractual agreement? You are talking in terms of payables, in terms of current liabilities. You are talking about non-debenture loans. It is nothing but non-current liability. And most importantly, you are talking about the preference shares. Again, I am saying this. Preference shares are there only in books. I don't think so. Preference shares are there. Very exceptional cases, we are using the preference shares as such. Is there very exceptional cases? Fine. That's what we will cover it. Now, is that these are the basic things. Now, that is the first part. Okay, that is the first part. What we say in the first part, we are talking about the financial instruments 32, 7, and 9. We are saying what is the financial asset and what is the financial liability. Going further in detail, okay, we will say what is the initial financial liability. It is nothing but the fair value. What is the financial liability? Assume you have taken a loan. It is a financial liability. Is it right? You have taken a loan or you have issued a bond. Is it right? Issued a bond. Then there is a contractual liability. It initially always, if we are talking about what? See, when you say the fair value, yesterday we have done, is it right? Yesterday we have done, what we have done? We have done something like our interest, rate of interest, is it right? Rate of interest. They will give two types of interest. One is rate of interest, one is effective rate of interest. Is it? One is effective rate of interest. Means what happens? What is the difference? Is that rate of interest is going to be, is it right? It is going to be, is it? This is at the time of issue. Is it right? It is at the time of issue. Means you are issuing, you are taking the bond loan. Is it right? You are taking the loan or you are issuing the bond. You are issuing the bond, assume you have taken it in the year 2018. Is it? At the time of issue, rate of interest will be different. Effective rate of interest is what? Effective rate of interest is the current rate. That is the basic difference. Always we have to consider, isn't it? Effective rate of interest. That is the reason we are talking about the fair value. What is the fair value? It is nothing but what is the net proceeds of the cash which is going to be received. Again, as simple as that. Is that there is no difference now. If you sell it, less cost to sell. Is it right? Less selling cost minus cost to sell. Is it right? Here also liability, cash received, cash going to be received minus cost of issuing. Is it right? Whatever the cost will happen, that cost has to be reduced from the total proceeds, total amount are going to be received. Then we have to take the net receipts as such. That is the recognition of the liability. Financial liability will be carried out on the amortized cost. Now you have good knowledge about this. Amortization, what? Amortization means yearly we have to reduce it. Is it right? The amortization works on what? Amortization works on the finite life. Is it right? It is, if it is a finite life, then amortization works. We are reducing it year on year basis. Is it right? We are reducing it on year basis. How much we have paid, we will use the net. Financial will be carried out amortized cost other than liabilities of trading or derivative. Derivatives is nothing but options. Write down in your notes. Is it right? Derivatives is nothing but the options. Is it? Don't get confused. Options is one of the classification of derivatives. Got my point? Option is one of the classification of derivatives. They are liabilities. Both are likely to be seen within the financial reporting. What is the amortized cost? See the thing. Initial value plus effective rate of interest. Most of the time the rule says if you take the market conditions now all over the world, the rate of interest will always increase. There is very less possibility that the rate of interest will decrease. Okay, there is very less possibility. Now, what happens? You are talking in terms of effective rate of interest minus interest paid. Okay, if whatever the difference. This is the way we have to show it in the calculations. We do the calculations in this way. You be very good in calculations here. Question bank we can do it very easily. Nothing is there. Is that the effective rate of interest will be different to the interest paid. Understand, right? Definitely it is not going to be the same one. Is it right? It is going to be the different with respect to the interest paid as such. Is it? It will be different to the interest paid. Means definitely they are giving us indication. If there is an additional cost of borrowing in terms of redemption, premium, in terms of we have to pay, rate of interest increases, definitely the interest amount will also increases. Is that in terms of any issue cost is there, in terms of any discounts on the issue, means What is the discounts on the issue when we take that into consideration? I will tell you like this. Is that when is that? What is the discounts means? The value of bond is how much? The value of bond is 100. Is it right? The value of you are issuing. Is it right? If see the difference. Okay. If you are issuing at lesser price, is it right? Less price. Assume 96. It is nothing but we are issuing at premium. This is the rule of financial instruments. Is it right? If you are issuing, if you issue at if a firm will issue at assume 104, it means they are issuing at discount. Is it? They are issuing at why it is premium. Okay, why it is premium? 100 reals bond you are getting at 96. Getting what? You are getting at 96 reals. Means that as an investor you are gaining. Is it right? They are issuing at a premium. Is it? If you are saying at 100 reals, for you are, how much you are going to pay to 104? Is that means you are paying more? Is it right? You are paying more. If you pay more, definitely it is going to have the time value of money. Okay, that is the reason we are talking about. We will do this in the next 1 or 2 slides. We will do the calculations, then you will understand what is the concept of a premium and what is the concept of a discount. Okay. One common form of financial instrument is deep discount bonds. What is the deep discount bond? It is issued at a significant discount to nominal value. What is the nominal value of the bond? Assume the nominal value of the bond is 100. Typically, we will not use as a rate of interest. What we will use it as a coupon rate. Okay, because when you are talking about the coupon, you assume it is 100 reals bond. Is it right? 100 reals bond for 5 years. Fine. What they will do? They will give you a coupons. Is it? It's not like a coupon. It's means at the end of every 6 months or at the end of every 12 months. Automatically the amount will be credited in your account. As simple as that. Is it right? The amount will be there is no, whereas in equity, what is there? In equity, they have to declare dividends, they have to announce dividends, profits, then declare dividends, and then they will transfer the dividends. Is that? In bonds, it is not like that. You have like a post-dated checks. Is that like a post-dated checks? When you have the post-dated checks, automatically you go to the bank on that day, you will get your amount credited to your account. That is called as a coupons. Is it? Whenever we talk about the bonds, make it a point. Loan will have interest. Is that? I will write here. When we say it is a loan, we use the word interest. When you use the word bond, is it right? We use the word coupon. Is it? When we are issuing the bonds, there will be issue cost will be there. There will be discounts on issue. Sometimes you will get annual interest payments will be there. Sometimes we will have premium or on redemption. Means you want to redeem it, you want to continue it. Definitely, if the bond is performing well, people want, if you are getting good returns on bonds, and there is a clause, if there is a clause of continuation, you can continue the bond for the next 5 years, 10 years, 15 years. Is it? This is where the net initial carrying amount of the bond will be net proceeds. There is a finance cost will be charged with respect to the bond. They will not charge one time, they will charge over the life of the instrument. Is that? They will charge on means continue. They will divide that finance cost. The constant periodic return is otherwise called as an effective rate. Little bit we have to focus on this. Is it? I don't know whether you have calculated internal rate of return IRR. Is that? Have you done this? You have done IRR? You have done internal rate of return? Any idea about this?
No idea.
You didn't do internal rate of return? Have you learned about internal rate of return anywhere? Previous papers? Any idea about this? Okay. Is it internal rate of return? Is it internal rate of return? Internal rate of return is the internal rate of return is nothing but what is the cost of borrowing and return on investments. Little bit. I'm not putting it very precisely. I'm giving you just a rough idea. This you will do somewhere, I don't know, this you will do somewhere in financial management F9. Okay, so don't worry about that. Is it? Just keep it in mind. That see what is internal rate of return. If you are borrowing loan, is it right? You are borrowing rate of 9%. If you borrow at the rate of 9%, definitely you have to earn from your business 9%. Then only what will happen? You can be in a position to pay off your loan. But a customer will buy, a firm will buy at the rate of 9%, and they are earning at the rate of 8%. Can the firm can repay the loan? No, the firm will not repay the loan. Means if the rule internal rate of return says that the value of the net present value should be 0. Means at least you should be in a position to cover the cost of borrowing. Is that this much you will keep? If you are borrowing at a 9%, you have to pay at 9%. Means you have to earn at 9% so that you will not be in a position to incur any losses. These bonds like most financial liabilities measured on amortized cost. What is the initial value? What is the effective rate of interest? And what is the interest paid? Okay, fine. Now, they have given you a simple one. Is it right? If you understand this basic question, we can understand all the questions in this lecture. Is it right? Only the loan issued. How much they have loan issued? They have issued a loan of how much? $1,000. Okay. The loan, is it right? Loan amount is how much? Loan amount is $1,000. How many redeemable? Means the loan note is going to be when you at the time of maturity. After how many years? The life is how much? The life is going to be 5 years. Is it right? The 5 years. What is the rate of interest? The rate of interest is how much? The rate of interest is The rate of interest is 5.9% and the effective rate, is it right? Effective rate is how much? 10%. Redeemable after 5 years. The value of that loan will be how much? 1,250. Is it? However, it is 1,250. Fine. Now, how much you are paying? 5.9% per annum. Is it right? 5.9% per annum. Is it? Now, total interest, is that? This is the step 1. Is it? Total interest. How much is the total interest? Total interest is how much? Is it right? How much? 1,000 into 0.059 into 5 years. It comes to how much? $1,000 into 0.059 into 5. 1,000 into 0.059 into 5. Is it right? 1 minute. 0.059 into 5. 1,000 into 0.059 into 5. Is that? Is that? How much is there? It comes to how much? It comes to 295. Okay? Now, plus add. Is it right? We have to pay redemption. Redeemable. Redeemable means repayment. Is it right? Redeemable. How much we have to pay redeemable after 5 years? Redeemable after 5 years will be how much we have to pay? 1,250. Is that how much you have to pay? Means we have to pay 1,250 plus every year we have to pay at the rate of 5.9% for 5 years. Is it right? How much you have to have amount? You should have an amount of how much? 1,545. Is it right? 1,545. How much you are getting right now? Is that how much you are getting right now? You are getting right now. You are issuing at what is the thing? You are issuing the bond. Is it right? The issuing the bond is how much? 1,000. Is it right? You are issuing the bond at 1,000. What is the difference? The difference is 545. Is it? This is the step 1. What is the step 1? It talks about what? It talks about how much we have to think over it. Is it right? We have to pay interest plus we have to pay redeemable value at 1,250 after 5 years. Is it right? 1,545. How much you are getting issuing the bond? We are issuing the bond at 1,000. What is the difference is? Difference is going to be 540. This difference we are going to work it out. Is that difference is we are going to work it out. How we are going to work it out? We will make it a point. Okay? Now, fine. We will make it a point as well. Now, what is the step 2? Is it step 2? We will classify this. Is it right? We will classify this and make it sure that how it is going to be how it is going to, what is the effective rate of interest and what is the rate of interest. Is that what is the effective rate of interest? What is the rate of interest? This is a year. This is the second one is opening balance. Is it right? The second one is opening balance. The third one is what? The third one is the effective rate of interest. Is it right? The third one is effective rate of interest. What is the effective rate of interest? Effective rate of interest at the rate of 10%. Is it right? Now, what is the cost paid? Is it right? Finance cost paid at the rate of how much? 5.9%. Is it right? Then this is the closing balance. Now, first year, is it right? Opening, how much we have issued? We have issued for how much? We have issued a bond of how much? 1,000. Okay. Now, what is the effective rate of interest? 1,000 into 10%. Is it right? How much is the effective rate of interest? Effective rate of interest is 100. Is it right? Effective rate of interest is 100. I am writing effective rate of interest. Is that effective rate of interest is how much? 1000 into 0.10. It comes to how much? 100. What is the cost paid at the rate of 5.9%? Is it right? What is the cost paid? The cost paid is how much? Is it right? 1000 into 0.059. Is it right? It comes to how much? 59. Fine. How much we have paid? 59. Is it right? How much we have paid? 59. What is it? This is column 1. This is column 2. This is column 3. This is column 4. Is it right? Column 5 is nothing but 2 plus 3 minus 4. 2 plus 3 minus 4. How much you will get? How much will get? 100, 1000 minus 49, 1041. Now you will understand, nothing is difficult as such. Is it right? Now, this closing balance will be the opening balance. Okay? This closing balance will be the opening balance. Now, getting a point? I will put like this. Is it right? 1 minute. This is column 2 times at the rate of 10%. Okay, column 2 times at the rate of 10%. Effective rate, whatever the opening balance we have to calculate. Is it whatever the opening balance you have to calculate? Now, when I don't have space, that is not, and I'm not doing. How much is there? See, I will write slowly in a very, very small terms. 1041 times 0.10. Okay? Is it right? 1041 times 0.10. How much you will get? Effective rate of interest. Effective rate of interest you will get how much? Take it at round figure 104. Okay? 104. Cost paid will be the same. Is it at the rate of 10% only? We are not 5.9% only. How much is there? 59. Is it right? How much is there? 59. Now, what is the column 5? 1041 plus 104 effective rate minus 59. It comes to 1086. Good. 1086. Now you understand how we are doing. Year 3. 1086. Is it right? What is the effective rate of interest? Can I write directly? 109. Okay, I am rounding it off. You can do it. 109. Okay, you can do it. How much is there? 59. Is it right? What is the last column? 1086 plus 109 minus 59. One one 3 6. Good. Salaam alaikum. This one. 1136. Okay. Focus this one. You do this. If you are understanding this question, Alhamdulillah, you are the entire concept of this lecture is only on this one. Okay. Nothing is there. Now 1136. What is the rate of interest? 1136 at the rate of 10%. 114. Can I put 114? Nothing will happen. Don't worry about the rounding off. Nobody will deduct marks for that. Is it right? 59. What is the last one? One 1191. Okay. 1191. Good. Fifth year. Is it right? Fifth year. 1191. Okay. How much is the rate of interest? 119. Okay. How much you have to pay it back? How much you have to pay it back at the end of fifth year? There will not be any closing balance. Is it right? At the end of fifth year, how much you have to pay it back? I will use another color. This one I cannot upload now on OneNote. I don't know what happened to it. They are asking something. Is that is the reason I am doing here in PowerPoint. Is it right? 1250 plus 59. Is that 1250 plus 59? How much it will come? Fine, 1250 plus 59. Now you see this one, effective rate of interest. How much into 13? Well, oh, don't worry about it. Now, effective rate of interest is how much? You do the total of column 3. How much? You do the total of column 3. 100, 104, 109, 1114, 119. $540, 540, take it 545, rounding off, okay? 546 or 545, rounding off, that's all. Nothing will happen, is it right? Here, there are, is it right? 546. Now you see the things, is it right? Now you see the things. What's happening? This 545 is the difference, is it right? This difference and this difference is nothing but the effective rate of interest. Is that? It is nothing but the effective rate of interest. This is what we have to way the calculations has to be done. Is that the amount carried forward at each year? Is it right? Now what happens? You have to amortize it. Is that you have to slowly and steadily. First you have to make it a point of showing 1000. Then we should be in a position, is it right? You have to pay it back 1250, is it right? When you have to pay 1250 plus interest, definitely what we do, we will make some investments. Is that we will make some investment. This is the classification how you have to do with respect to, first you have to calculate the difference is nothing but, it is nothing but the difference in between the effective rate of interest and the rate of interest. Fine. Interest paid. Is it? The effective rate of interest and the interest paid. Now this 545 should be matched with the effective rate of interest. Are you clear about this? It took a lot of time for me, okay? It took me a lot of time just to make sure that to understand this. Now, if you make a point, the other calculations are it's really a very piece of cake. Don't worry about that. When I'm saying the only thing is you should know how to work it out, the step 1 and the step 2 as such, okay? This is the way we are going to work out with the bonds issue as such. Fine. Now, a company issues 5% loans. Is it right? A company issuing how much? 5% loan at the nominal value of how much? 20,000. What is with the effective rate of 5%? The loans will be prepaid for 4 years. What amount will be recorded as a financial liability when the loan is issued? Is it right? When the loan is issued, this is point number A. This is point number A. Is it right? When the loan is issued, what we have to record and what amount should be shown in the profit and loss account and statement of financial position. Now, what amount should be recorded? Recorded is nothing but it is a general entry. Now, if it is a general entry, what will be the debit and what will be the credit? Any idea? Yes or no? Don't waste time. Tell me fast, yes or no? Nothing will happen, don't worry about that. If you don't know, don't say yes, I know. If you say yes, yes, say don't, yeah, good, I see, fine, good. No, don't waste time, that's only my request is that much, okay? Now, what happens when you are issuing the loan? Loan is a liability. Is it right? Loan is a liability. Always liability will be on the credit side. Khalas. 100%. There is no doubt on that. We are, is it right? What will happen? Make it a point that credit is what? Credit is loan. Is it right? Loan notes. Is it? Always asset will be on the debit side, liability will be on the credit side. Is it right? Rule, keep it in mind. If debit, sorry, Allah Kareem. Is it? See the thing. If asset if asset increasing, it should be on the debit. Okay? If the asset is going to be decreased, it should be on the credit. No other second thought. Okay? Next. If the equity, we are talking about equity and liability. Equity and liability increasing, it will be on the credit side. Is it right? If equity and liability is going to be decreased, it should be debited. This is the rule. When I am putting it in box and I am putting with a star mark, this is the rule for general entries. Okay. Now, when you are taking the loan, is it right? When you are taking the loan, what will happen? It is a liability. Liability increases. When the liability is increasing, it will be on the credit side. When you are taking the loan, what is happening? Cash is coming to you. Is that it is an asset for you? Is that cash increases? Cash increases. If the asset is increasing, what is the rule? It says it should be on the debit side. Is it right? We can put it as a cash, or you can put it as a bank. How much? 20,000. Is it right? Being loan amount received. Fine. Being the loan amount received. Fine. That's what it says. Now, next, what you have to do? What amount will be shown in the statement of profit and loss account and statement of financial statement? That's what we are talking about. Is it right? Same process what we have done in the previous case. Okay. Same process what we have done in the previous case. Just manage with this. Okay. I need space. That is the reason. Is it right? I need space. Now, Five percent loan, effective rate of interest is 5%. Effective rate of interest is also 5%, and the loan amount is also 5%. Fine. There is no difference here. Got my point? That is the reason. There is no difference as such. Fine. Good. Step 1. Okay. Put it. Nothing will happen. Step 1. Is it right? Now, year, opening balance. Okay. Opening balance. Very fast. Okay. I'm repeating it. You have effective rate of interest. You have effective rate at the rate of how much? At the rate of 5%. You have finance cost. Is it right? Finance cost at the rate of 5%, and you have the closing balance. You have the closing balance. 1, 2, 3, 4. Is it right? 1, 2, 3, 4. Now, opening balance is how much? 20,000. Is it right? How much they have issued? They have issued for 20,000. Effective rate of interest is how much? Effective rate of interest. Is it right? See, when we are doing this, this is column 1, this is column 2, this is column 3, this is column 4, this is column 5. Okay. This is column 2 times column 2 times 5%. Okay. Column 2 times 5%, and what is the cost paid? It is nothing but loan amount into 5%, rate of interest, finance cost. Okay, and 2 plus 3 minus 4. Is it right? 2 plus 3 minus 4. Don't wait for me. Don't wait for me. You do on your own. Is it right? It comes to how much? It comes to 1,000. Is it right? It comes to 1,000. How much? 20,000. Fine. The same thing. Now, see, you will find, but we are going to understand in a different way. Is it right? 1,000. Okay. It is going to be how much? 20,000. Third year also 20, opening balance will be same, 1,000. Is it right? 1,000. It comes to how much? 20,000. Fourth year we will repay it. Okay, we will repay it. Effective rate of interest is 1,000. Is that how much we will repay? We repay what we have done, 20,000 plus the interest also. Is it right? There is nothing like that. Now the comment. Okay, now this is important, comment. When the loan amount and the repayable amount, okay, and the repayable, redeemable, I can put like this, redeemable amount are same, is it right, are same, it means that the 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 loan notes are repaid, is it right, repaid at par, is it right, repaid at par. Means what? Par means whatever you have received and whatever you have paid, the both amounts are same. Is it right? Now, I will take this much space, okay? I will take this much space. I need, this is step 3, okay? This is step 3. Step 1, oh sorry, step 1, this is step 2, okay? This is step 2. Now, they are talking in terms of profit and loss account, okay? They are talking in terms of profit and loss account. Is that 1, 2, 3, 4, okay? 1, 2, 3, 4. How much is the profit and loss account? In profit and loss account, we are going to show it as a finance cost. Is it right? Finance cost. How much is the finance cost? Every year, finance cost is 1,000. Is that finance cost is how much? 1,000. Fine. Now, I'm running out of colors also here. Okay, next. Balance sheet. Okay, statement of 4. Is it right? Oh my gosh. Statement of financial position. Allah Mia. Done. Is it right? Statement of financial position. Okay. Now, statement of financial position, you have to be very careful. Is it right? What you have to do? Non-current liabilities and current liabilities. Is it right? Non-current liabilities and current liabilities. Fine. Now, you are paying it at the end of the, is it right? Make it a point. It has to be in the same way. Is it right? First year, second year, third year and fourth year. Is it right? First year, second year, third year and fourth year. Now, you are paying, are you paying in the first year? Repaying at the first year? We are not repaying in the first year. Is it right? We will repay at the end of fourth year. Means if you are not paying in the first year, it is going to be identified as a non-current liability. Okay, first year. Second year also, are we paying? we are not paying in the second year also. Again, we are going to classify as a non-current liability. Is it? Again. Now, see the thing. Third year, at the end of the third year, is it right? At the end of the third year, we are going to pay it in the fourth year. What is the definition of a current liability? The definition of the current liability is if it is going to be repaid in the next 12 months. Is that if it is this is at the end of third year, is it? At the end of third year, we are not going to show it as a current liability, non-current liability, but where we are going to show, we will show this in the current liability. Because the reason is we are going to repay this after the end of the fourth year, next 12 months. And by the time you are doing for the 12 months, this current liability will become zero. Is that this current liability will become zero? Got my point? This is the way the classification has to be done. This is what they say. What amounts will be shown in the statement of profit and loss account and the statement of financial position for the year 1 to 4. Is that for the year 1 to 4 how much we have to show? Here I will write it again. Is that if you take this into consideration, is it right? Where is that? Fine. Is that this will be called as a non-current liability. Is it right? This will be called as a non-current liability, and this will be called as a current liability. By reason behind current liability, this is going to be repaid in the fourth year, next 12 months. Here it will become how much? Zero. Understand carefully. Write down. Anything is there, refer the recording. Is that right? Anything is there, refer the recording. Recording will give you a complete detail without any doubt. If any doubt is there, just tell me. I'm saying very simple. Don't say yes all the time. Don't say yes all the time. Any doubt is there, you stop me, you question me. Understand point? You stop me, you question me. When you are revising it, when you are practicing it also, if you have the doubt, immediately you send me in the group. If Rizwan is posting any question, Shifa, you respond. If Shifa is posting any question, Rizwan, you respond. The moment there is a teamwork, see, learning from the team is very important and very effective. Is it right? So that immediately you can know whether you are understanding and what you are giving is right or wrong. If there is anything gap is there, inshallah, I am going to come and say that no, you have to do like that. I will respond to the answer which has been given by the other person. Wherever you are studying, wherever you are doing, make it a point. There should be a complete team understanding. Is it right? It makes really a good way of learning. Fine? Yes. What it says? A company issues 0% loans. Fine. No. It's very strange, is that right? A company issues 0% loan notes at a nominal value of 40,000. Is that at a nominal value of 40,000? The loans are repayable at a premium of 11,800. Is that right? Premium. Premium is what? 11,800 means how much we are going to pay? 40,000 plus 11,800. Okay, 40,000 plus 11,800. Okay, that's very important. Now 40,000 plus 11,800, it comes to 51,800. Okay, very simple. Should I do, or you can do? Wait, we will do it. Okay, it takes time, nothing will happen. Very important. We are going to take this at a later stage. Now, what is the loan amount? Is it? Loan amount is how much? Loan amount is 40,000. Is it right? Loan amount is 40,000. Rate of interest, is it? Rate of interest is how much? Rate of interest is 0%. Is it right? Effective rate is how much? Effective rate is 9%. Is it right? Effective rate is 9%. Now, after how many years? Life is how much? The duration is, you cannot say life, sorry. Duration is how much? 3 years. Is it right? We need anything else? No. Okay, 11. And how much is, we are talking in terms of premium? We are taking the premium into how much? 11,800. Fine. They are asking you two things, A and B. It's the same thing what we have done in the last case. Don't wait for me. You do it fast. Okay. What is the point number A? What is the amount recorded as the financial liability? How much is the debit and what is the debit and what is the credit? Tell me fast.
Debit will be bank or cash.
Good. Debit will be bank. Bank. Make it a bank. Okay. Don't. Next time you use bank or cash, nothing will happen. Okay. How much? 40,000. Credit will be what? Credit will be loan notes.
Loan notes.
Credit will be loan notes. You write on that. Okay. Being loan notes issue. Is that being no loan notes is issue? Fine. Okay. Next. Fine. Now, this is the B, point number B. Is it right? Year opening balance. Is it right? Opening balance. You have the final effective cost. Is it right? Effective cost at the rate of 9%. Is it right? Write down finance cost. Finance cost at the rate of 0%. Is it right? Finance cost at the rate of 0%. You have the closing balance. Fine. 1, 2, 3, 4. I'm little bit fast. Okay. Don't worry about that because already we have done. Is it right? This is 1. This is 2. This is 3. This is 4 and this is 5. Okay. You know the thing. Opening balance will be how much? Opening balance will be 40,000. Is it right? At the rate of 9%. Okay. At the rate of 9%. How much you will get? $4,000 into 9. It comes to how much? Very fast. $3,600. Good. Is it right? 3,600. What is the rate of interest? Rate of interest is 0. Is it right? Now, what is the column 5? Column 5 is nothing but 2 plus 3 minus 4. Is it right? 2 plus 3 minus 4. 43,600. Is it right? 43,600. At the rate of 9%, how much? 3924. Okay. 3924. Is that 0%? What is the total? What is the total of this? 4, 6, 4, no. 47524. 47524. Good. Is it? I will make you fast, okay? Don't mistake me, but I will make you fast, okay? Fine. Next, how much is the interest rate? 9%. Four two seven seven. Okay, 4277. How much is there? This will be a non-current liability. Now you understand. This will be a non-current liability, and this will be what? 51801. That's what it says. Is it right? 5180. How you get 51801? Is it right? 5 means 40,000 plus 11,800 premium. Is it right? 51,800. Okay. This will be a current liability. Fine. That is going to be paid when that is going to be treated as current liabilities. Okay. Treated as current liabilities, and by the time you will go to the last year, it will be how much? It will be 0. Okay. Is it? Fourth year you will not have that much things as such. Is it right? How you are going to be? This is the step. I don't know whether we have done previously. We have done step 1. No, A and B. Okay, A and B. Fine. Put it like, is it right? Step 1. Is it right? Presentation. Is it right? Presentation in financial statements. Is it right? Income statement. Income statement. Fine. Income statement 1, 2, and 3 and 4. 4 years. How many years we have to get? It is 3. Yeah, it is 3 years only. Is it right? Sorry, I have made it 4. It is only for 3 years. Sorry. Is it right? It is only for 3 years. Is it right? Income statement. What is the finance cost? Is it right? What is the finance cost? Finance cost is 3,600, 3,924, and 4,277. Okay. In the balance sheet, statement of financial position. Is it right? In the non-current liabilities, how much? First year it is going to be 43,600. Second year it is going to be 47,524. And in the third year it will be how much? It will be a current liability of how much? Nothing will be there. Is it right? No, we will not. Now it is second year. Sorry, it is here also. Here we will treat as a current liability because we are going to pay it in the third year. I thought it is 4 years. Okay, it is going to be the moment next 12 months. Okay, that is the basic condition. The moment it is going to be repaid in the next 12 months, it is going to be treated as a current liability. Is it right? How much is there? 4752. Is it okay with this? Fine. A company issues 4% loan, nominal is what? The loans issued as a discount of and 534 are issue cost. The loan notes are repaid at a premium 10%, 5 years. The effective rate is 7%. What amount should be recorded in the financial liabilities? Fine. Okay. This is somewhat different. Okay. Extension of that only, but it is different. Okay. Fine. Now What they are asking us? They are asking is what is the amount of financial liability when the loans are issued. This is the thing. Now, is it right? I will write here only because I don't want to take on. Is it right? Working notes. Okay, sir? Working note 1. Okay. Sorry, only please manage today. Okay. I don't know some I have to download some patch for that one note. Okay. Please, only for today. Is that how much is the first? How much is the nominal value? Nominal value is how much? Nominal value is how much? Nominal value is for 20,000. Is it right? Nominal value is how much? 20,000. They have issued a discount. Is it right? Less discount. Is it right? Less discount. Discount at the rate of 2.5%. How much is there? 1% is 2,000. 2.5% is how much? 500. Is it right? Please check my answer. Okay. Issue cost. Is it right? Issue cost is, they have already given the issue cost. Is it right? Issue cost is how much? 534. How much will get? Tell me fast. $19,000. Yeah. What is the answer? Why it went back? What is the answer? 20,000 minus, I have to do otherwise. 20,000 minus 500 minus 534. 18,966. Is it right? 18,966. Point number A. Is it right? A solution. Solution to A. How much we have? What is the debit and what is the credit? Debit is the bank. Is it right? Credit will be the loan notes. How much? 18,000. Where are you people? 18,966. Is it right? 18,966. Fine. Where are you people? Yes. Are you clear about this? Yes. Yes. Alhamdulillah, Alhamdulillah. Thank you so much. Fine. 18,960. Good. Okay. Next. Is it fine? Now, what they are asking is, they are asking it only for 1 year, okay? They are not asking for anything else. They are only asking for only what amount will be shown in the profit and loss account of the statement of financial position for year 1, okay? For year 1 only we have to show. Is it right? First we'll do same thing. Is it right? Year year opening balance, very simple now. Opening balance, is it right? Effective rate. If you can work out this now, nothing is difficult for us, is it right? Effective rate at the rate of 7%. Finance cost at the rate of how much? Finance cost at the rate of 4%, is it right? Finance cost at the rate of 4%. Closing balance only for year one, okay? Only for year one only. One opening balance is how much? How much is there? 18,966. Is that 18,966 into 7%? It comes to how much? 18,966 into 0.7. 1328. 1328. Round it off, okay? Please. Don't worry about that. If you round it off, round it now. Don't put in decimal. That's all. Okay? Nothing will happen. That is not an error. Okay? Next. How much you are going to have? Is it right? Here what we'll do, finance cost will be always carried on the loan amount. Is it right? Always on the loan amount. Make it sure. Is it right? On the loan amount. Is it right? 20,000 into 0.04. It comes to how much? 800. Is it right? Closing balance is same. 2 plus 3 minus 4. Is that 2 plus 3 minus 4? 18,966 minus 1328. How much is there? 17,638. What is this? 75919. How much you will get? Allah Kareem. It means you see, if you, yes, check again. 17638. 17638. 18966, 13 plus 1328 minus 800. Okay, you should not do mistakes now. I am saying this. I am requesting you, no mistakes should be there. Calculation mistakes should not be done. Okay? Is it clear? Good. Fine. Now, what is the profit and loss income statement? How presentation? Is it right? How again presentation? See, this is what we are learning. Nothing is there. Now you can understand. Tomorrow class will be very easy. Take my word. Is it right? Now we will is it right? What is there in the finance cost in the year one? Year one, is it right? How much you are doing finance cost? Finance cost is how much? 1. Is it right? 1328. Is it right? And in the statement of financial position, how much? Non-current liability. Is it right? Non-current liability. How much will show non-current liability? Rizwan, you check your answer, Rizwan. Shifa answer is right. Rizwan, you check your answer. Shifa answer is right, sorry. 18966 plus 1328 minus 800. Is it right? 19. You have to add, na dear. 494. Okay. Non-current liabilities are much? 1 19494. Is it clear now? You understand the things? Hopefully it's easy. Is it right? It's easy. It's not difficult. Okay. Fine. We'll do this second. We'll complete preference shares and will stop. Okay. Nothing is there. No, is this? No, I'm telling you now. Okay. Now it's Alhamdulillah. You can have very comfortable situation. Okay. Now we will do this. We will do example 5 and we will stop. Okay. Inshallah. What is the preference shares? Preference shares is nothing but you have preference over the dividends. That's all. Is it? Preference of dividends only. Is it? Now I will say how it will be reflected. Is it? You will have profit after tax. Is it right? You will have profit after tax. Then you will pay preference dividends. Is it right? Is it right? Next you will pay equity dividends. Only there is a preference with respect to dividends. Is it right? Preference with respect to dividends and with respect to equity dividends. Just 1 minute. Yeah, sorry. Okay. Now, fine. Good. Yeah, only they have the in terms of, and during the time of liquidation, understand this. Forever you should remember this. What is the concept of preference shares? Even at the time of liquidation, before you pay off to the equity shareholders, you will pay to the preference shareholder. Okay. What is the concept of preference shareholder? If redeemable preference shares, redeemable means you will if it is issued for 5 years. Is it right? If it is for 5 years, redeemable for another 5 years. Okay, you have that option to continue or not to continue. If redeemable preference shares contain no obligation to make any payment, either of capital or they are classified as equity. Is that there is no obligation? Assume that means sometimes you will not pay dividends. Okay, what will happen? See what is the concept of a preference shares and what is the concept of a equity shares. You should have very clear concept. Is it right? In terms of preference shares, is it right? They will pay you dividends. Is it right? They will pay you dividends year on year basis. Is it? Subject profits are there. Understand what? Subject to profits are there. They will pay before paying to the equity shareholders. If there is no obligation, is it? If there is no obligation, there is nothing like that, there is no clause attached to it, then the preference shareholders is going to be treated as a normal equity. Is it? If the preference shares are redeemable, they have the fixed means they are what they say. Now, what is the another characteristics of preference shares? The another here what they say, there is a fixed percentage of dividends. Here there is no fixed percentage. Okay, there is no fixed percentage. That is the basic difference. Is that if preference shares are redeemable or have a fixed cumulative dividends, then it is a liability, financial liability. Means liability for the firm to pay. Is it right? The key element is that where there is no obligation, this instrument represents a liability. Means more or less equity is also a liability, preference shares is also a liability. There is basically condition to that, whether they have any fixed percentage of paying of dividends. What is the accounting treatment? The accounting treatment of interest and dividend depends on the instrument is. Equity dividends are declared or reported directly in equity. Whereas, if we are taking into consideration, it has to be identified as a finance cost in the profit and loss account. Dividends on instruments classified as a liability. If preference share is classified as a liability, see, equity dividends, now you say, where you are going to show? You are going to show in statement of changes in equity. Is it? Whereas preference dividends will be shown in the profit and loss account. I will ask you this question somewhere down the line. Is it right? I will ask you this question somewhere. If it is treated on par with equity, it has to be shown in the statement of changes in equity. If it is treated as a liability, then it has to be shown in the statement of profit and loss. Are you clear about this? Is it right? Next. Can I do this one? Is it okay? Good. Is it? We'll complete this and we'll stop. That's all. Nothing is there. Is that? Now, how would on April 2001, company issued 40,000 1% redeemable preference shares with a coupon of how much? 8%. Again, coupon, we will not say the interest as such. Is that? We use the word coupon. They are redeemable at a large premium which give them an effective finance cost of 12%. How do these redeemable preference shares appear in the financial statements for how many? For 2008 and 2009. Is it right? Now, how much they are going to pay annually? Is it right? How much they are going to pay annual payment? Is it right? Working notes 1. Is that step 1? First, is that what is the annual pay interest, annual coupon payments? Is it right? Annual finance cost. You put it as like this. Annual, no. No. Annual. Fine. 1 minute. What is the annual cost? Is it right? Annual coupon. How much they are going to pay? Yes. Annual cost. We are not taking effective cost. 1 minute. Okay. Annual cost. 40,000 times 0.08. Is it right? For 8 4s are 32. 3,200. Is it right? 3,200. Effective cost, we will do the effective cost based on the opening balance. Is it right? Effective finance cost will be based on what? it will be based on opening balance. Okay, it will always, okay, always it is based on opening balance. Fine. Now we are talking about year end 2008 and 2009. Fine. Step 2, year end 2000, year end, okay, year end, fine, year end, okay. You have the same thing, opening balance, effective cost, is it right, finance cost, and closing balance. You can understand there is no that much difference, only the concept difference is there. Is it right? 2008 and 2009. Opening balance is how much? 40,000. Is it right? How much they have issued? 40,000. Effective rate of interest is how much? At the rate of 12%. Okay, and this is at the rate of 8%. Is it right? 1, 2, 3. 3 is nothing but 2 times 12%. Is it right? This is loan amount into 12%, preference amount into 8%, closing balance. 2 plus 3 minus 4. Is it right? 2 plus 3 minus 4. How much you will get? 4,800. 4,000, 12%. It comes to how much? 4,800. Good. And it is how much? Through 3,200. Is it right? 44,800 minus 3,200. 41,600. Is it 41,600 into 12%? How much? 4,992. Good. Is it right? 4,992. This will be 3,200. Okay. And how much? $43392. I'm just taking your amount, okay? 43392. Fine. This is done. Step 3, okay? Presentation. Is it right? Presentation. Income statement. Is it right? Income statement. Is it right? 2008 and 2009. 2008. Is it right? How much is the effective cost? Is it right? Effective finance cost. Is it right? Is it right? 4,800 and 4,992. Okay. The statement of financial position, non-current liabilities. For how many years they have issued? They have issued. They have not tell anything. Is that preference share? They are redeemable at large premium. They didn't say anything duration. Okay. They didn't say any duration. Okay. Means it is going to be a non-current liability only. Okay. How much? 41,600 and 43,392. Is it clear to you? Fine? Fine. Okay? 1 minute.